Hey, hello traders, it's March the 1st. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give you your FX market wrap up and now look for the final 24 hours of this trading week, and inevitably we have to go a little bit beyond the weekend to see our bigger themes playing out. Now, we continue to monitor volatility across the markets, and that actual measurement of activity and potential for trend generation, which I see within volatility, has backed off a little bit, especially from the peaks that we had the previous session, and especially on Monday with those very, very substantial gaps on many of the markets. Now, this back off on volatility does not necessarily mean that we are completely losing our probability for activity, but heading into the end of the week, we have much bigger event risk to look forward to in the evening hours of Friday into the weekend, and then some bigger stuff next week. So with the knowledge that there is major event risk further along the line, will we necessarily see a big movement from the markets before that? Who wants to position before heavy markets? Something to consider, but I put this into context and I draw the same question. You see something with the Aussie dollar here. All right, from a technical perspective, look at what we have. This is a great technical setup. This is a broad range. All right, this range spans from around 101.75, you could say 102 roughly, and it goes all the way up to 106, so a nice 400-point range. But we also have a descending trend line here, which is actually a descending channel. We are likely to see a breakout either to the upside or the downside, and with each day that passes, this range becomes smaller and smaller, and a breakout is necessitated just because it runs out of room. But you need a fundamental catalyst. You have to have commitment. You have to have the market see the potential for follow-through after the move. Otherwise, it's a false breakout into a reversal, and those are quite frustrating, as many of you are certainly have at least been once been affronted by one of those situations. We try to avoid those as much as possible. So this Aussie dollar is a great representation of the situation that we are currently facing. There's a great amount of technical patterns that have a lot of pent-up potential. However, we are waiting for those volatility events that can generate the necessary momentum to move the markets first, but also to keep the markets moving, to jumpstart those trends that we have long seen as a possibility across the board. Now, with the Aussie dollar, there's no mistake in what its catalyst is going to be. Of course, you can always keep a close eye on generally the individual aspect of the Australian dollar, and one of the individual aspects there is the appeal of the Australian dollar and its benchmark bond, government bond, for a higher yield safe haven. All right, we've seen a lot of safe haven interest, and we know that the RBA just the other day said that it believes that the currency is 4 to 15% overvalued. Well, you put that against something else that they also said that they see approximately 34 central banks have reserves in Australian dollars, and you see the new appeal of the currency itself. All right, but there is one thing that I think that the Aussie dollar simply cannot get away from, especially when you're talking about measuring it against the US dollar. And of course, that assessment, that fundamental driver, is risk trends. All right, here once again, looking at the S&P 500 is our benchmark for sentiment. Why is it a benchmark for sentiment? Because one, it's typically a long-only investment for the bulk of the market, and it also is a reflection of stimulus. Okay, stimulus is a very, very important component to the performance of the S&P 500. But risk trends in general are what guides the Aussie dollar. So the fact that we did have that really significant rebound from the previous session here did in fact stall the Aussie dollar from breaking this floor at 101.75 and keeping us moving to a more prominent technical floor. All right, but that threat, that possibility still remains. We just need to see conviction one way or the other. So our argument must evolve into something more thematic, something bigger. Risk trends. What is going to jumpstart and sustain risk trends? And I will be watching the S&P 500, and this is the Dow Jones Industrial Average, CFDs, they're future-based. This big line up here is the record high for the Dow Jones Industrial Average. This past session, we actually had a pullback from the U.S. equity indexes, which was to be expected when you look at the volatility performances, which is a reflection of fear. You can see that both the FX and equity versions of volatility have both seen a significant pullback, although the VIX actually has bumped up a little bit. They are off their highs. And to get that to overwhelm stimulus, you have to have something very, very prominent. And that very prominent influence is going to be risk-based trends. All right, so keeping a very close eye on the risk-reward index versus the S&P 500. The risk-reward index has actually bounced a couple of days, but it is still very much in a bearish theme, a bearish trend. And it's very much likely that we see that the S&P 500 catches up to the fundamentals, just as we saw back here in November of last year. There was a drop in the S&P 500, but risk trends were relatively stable. You had that reversal, and the market came back to meet the fundamentals. All right, but there are some catalysts along the way. There are some milestones that we have to meet to see if this is indeed the case, if this is how it's going to play out. And they're very important catalysts. So this past session of event risk carried a number of notable pieces of data, including the BOJ nominees we'll talk about in a second with the yen crosses. We also had the Eurozone CPI, which is going to be important for the ECB next week, also a topic of conversation in a second. But we didn't really have anything that was, I would say, big systemic risk kind of situations. Nothing that really tapped into the global risk appetite theme. And without that driver, you're not going to be able to get a big market movement, a dedicated and committed market movement to either a bull trend or a bear trend, a deleveraging or a buildup of higher yielding risky assets. And so where are we going to look? Are we going to get it in the upcoming session? Here's the docket for the upcoming session. You can see that once again we have some notables, but nothing that really comes with a very, very clear, once again, systemic threat. The one systemic threat that I would be looking for is this: the U.S. deadline for automatic spending cuts, or as they call it, the sequester. All right, this doesn't actually have a time frame for it, because it can be done. It could be fixed at any time. However, it's unlikely to be fixed. Congress actually shot down two competing bills this past yesterday, and essentially called it a week. They went and they folded for the weekend, and they said they'd come back after the weekend. So we do have a meeting with the congressional leaders and the president at the White House on Friday, but as it stands from both sides, it looks like there is going to be nothing done to prevent these spending cuts from going through. So it's very likely that as it's estimated, $85 billion in cuts through 2013 is going to be put on the books, and that weight on growth is going to hit. So how would that impact the markets? Well, first, let me tell you that the actual expiration, is the 11:59 local time p.m. So it's going to be well after the U.S. market close. Of course, we can actually have policy officials come out and say that they're not going to meet any kind of necessary requirements to forestall these efforts, but it's unlikely that we will get it before the U.S. close, generally because they probably don't want to impact the markets too much, as well as they might continue to converse on the issue well into the evening. So unlikely that we have a situation where we actually see this play out before the market closes. That being said, remember what happened this past weekend. We had the Italian election. We had the Cypriot election. We had the market, or the financial journalists, talking about the leading BOJ candidates. All right, all those factors played into some very significant volatility on the opening of the week. All right, so once again, we are going to be looking at a potential very dramatic open for the week. And that's not the only thing. That's not where we stop. The event risk as we go into next week becomes much heavier, much more influential. And I think that the biggest event risk is going to come really on Thursday and maybe Friday with non-farm payrolls. But Thursday, you're going to get into the ECB and BOE rate decisions. Both are expected to come with some stimulus stimulus conversation attached to them. That's going to be very, very interesting, and that's going to be very volatile and volatility inspiring. But risk-based trends are going to be watching very closely that sequester. All right. So the Aussie dollar has its potential break tied up into really anything that can get the markets moving on risk trends. And the sequester has the best potential, but the sequester doesn't really come through and really impact the markets, or is unlikely to, until after the end of the week. So with the Aussie dollar, keep a very close eye on the U.S. equity indexes and the financial headlines, looking for anything related to the sequester. But the Aussie dollar is not the only pair that's going to be impacted by this. We'll be watching the euro dollar. All right, the sequester, as we've seen, can have a good impact on risk trends, and the euro dollar certainly has its influence, its reactions to risk-based trends. In fact, this is something that I was showing weeks ago, and I continue to update for some time. And I warned that the correlation between the euro dollar and my risk-reward index was at an extreme low. All right, when that correlation hits an extreme low, it's very likely that euro dollar, which what that means is it's deviating from the standard, seeking out risk with a higher return, or seeking out safe haven in the U.S. dollar. It doesn't stay away from that theme for too long. It eventually snaps back, and it snaps back typically with big movements in the market. Well, look at exactly how that played out. We had that trough, and what do you have? A peak in the euro dollar, and we had that reversal as the correlation picks up once again, because risk aversion kicks in, and risk aversion influences the euro dollar once again. That's why the correlation kicks back in. This is what it looks like individually in their performances. All right, so that was something. Fundamentals do have their place. You should definitely pay attention to these fundamentals, and it's a strong argument for the risk, kind of the risk theme monitoring, and keeping that in the back of your mind. So with the euro dollar, if we do have a strong move in the equity markets, expect the same thing for the euro dollar. Now, of course, we do have the ECB rate decision next week. We'll talk a little bit more about that in depth tomorrow when we do the weekend video. But aside from that, there has been a lot of talk about what's going to be done with the Italian elections. Well, the president of Italy came out this past session and said there's no way to accelerate the effort to develop a full government, to come to agreement with the full government. They have to wait 20 days, according to the Constitution, after the Parliament first meets before they can go in for a new election. So we're not going to be getting a re-election in a while. So as of right now, it stands with a complete dedication to looking for a coalition. But as you've seen, we have very little interest to develop a coalition with certain parties that are anti-austerity and to some extent anti-euro. They're looking more for the Greek stability than they are for Eurozone stability. So that is going to be a lingering issue, but once again, it doesn't have a countdown attached to it. So we're not going to be watching that as an immediate threat. We need something else that has that risk, that fear, that unbridled concern attached to it. So the euro dollar is going to be another one. And of course, the one that I'm most interested in is the yen crosses. All right, the dollar yen, as you see here, I have still that reduced size dollar yen and euro yen short position. I've not added to the positions because I'm not seeing a very strong argument to be made that can actually drive these yen crosses significantly lower. And of course, there's a possibility, but the possibility is not as high as a probability as I like. So I will keep it at small size and see how they develop. But risk aversion is extremely important with the yen crosses. All right, extremely important. You can see that through the dollar yen pattern that you have here, the euro yen pattern, the pound yen pattern. All right, you have much of the same overall setup. And we can even pull it over to the Aussie yen, which is one that I completely exited out of, with a former support standing in as new resistance. You see it again across all of these yen crosses. All right, it's a very common technical pattern, and of course that is when you have all these markets sync up for a technical view, suggests that they have a good continuation. Just like if you saw it on an individual currency pair, you say that's a good former support standing as new resistance potential continuation pattern on a reversal. But once again, it depends on what the fundamental drivers are. You need something that actually leverages the yen higher. It's a tall task, a very tall task, to actually get the yen moving higher. Why? Well, we have to go back to what our conversation was. We know what the threat has been to the Bank of Japan, from the Bank of Japan, that they would leverage up the stimulus efforts that they have threatened. All right. So if we look at the actual stimulus efforts between the United States and the Japanese, you can see that there has been a substantial deviation. The dollar yen has shot higher, meaning that the yen has dropped off because there's expectations of more stimulus from Japan. But in fact, the U.S. continues to build up its stimulus, but Japan has not actually moved. All right, this is purely on the assumption that there's going to be more, just not yet. So we have gotten the nominations from the Japanese government. They have pulled a governor and two deputy governors who are, we have seen in their speeches in the past, are very, very dovish. And they are very likely to vote towards increasing the stimulus effort. How that's done remains to be seen. Whether that means that they're going to move up the start date on their 13 trillion yen per month program that's supposed to start in January of next year to an earlier date. Or perhaps they're going to expand, or perhaps they're going to increase the maturity of the Japanese government bonds that they're going to buy, or maybe they're going to buy other assets like equities. All right, it remains to be seen, but there's certainly expectations that there's going to be more stimulus, that this deviation will close, that you'll see this catch up. All right. If that is indeed the case, the yen crosses have a very strong magnetism towards a bullish move. So you need to offset that, because we still have a number of weeks before this is actually realized, because the actual exit of the current regime, Shirakawa and his two deputy governors, doesn't happen until March 19th. All right, the first rate decision by the new Bank of Japan officials doesn't happen until early April. So we have, in essence, a whole month before that we actually see those stimulus efforts realized. Of course, we can get speculation early on, but they're unlikely to offer up a lot of commentary to undermine the current policy officials until we get closer to that March 19th resignation date. So we do have, if you want to play it safe, really only 2 weeks of, or maybe 3 weeks of undisturbed opportunity to respond to risk-based trends. All right, but it's going to be the inclination that people are going to want to short yen if things are going to remain relatively stable. Why? Well, consider you have a carry trade if you're long yen crosses. So the yen crosses are extremely important in this bigger picture. We need to see if this is going to have a risk aversion move. And once again, our focus remains on risk trends. All right. Very, very important that we look for risk trends to develop some meaningful traction. And if it's risk on, all bets are off. This is going to be a really weird situation, and it won't have good, meaningful trend development. But there are some opportunities on the opposite side of that. One of those opposite side opportunities, well, this is my risk aversion outside of the yen-based crosses I currently have on my Kiwi dollar. And as you can see, this actually has held that former support zone as resistance at that trend line, and it has good continuation. But this is once again a risk aversion setup. The Aussie dollar is kind of a sister currency pair to this one, with a very similar look. But the Aussie dollar hasn't actually made its break. The Kiwi dollar has, so it's now kind of waiting for the fundamentals to start the engine and keep it going. The alternative is the dollar CAD. Now the dollar CAD, I am short. I am still short. It hasn't actually hit my my stop, which was at actually at 103.15. It got dangerously close. But risk appetite trends actually does support this particular pair, especially after that very aggressive move that we had to the upside 7 consecutive days. A nice confluence, and certainly the biggest of that confluence is this descending trend line here that maps out approximately 4 years of price action, or 3.5 years to be precise. But you can have a false breakout with the reversal here, and that's a possibility, but this is just one opportunity for a risk positive move. If you want risk positive, you have to look for things that aren't you want things that are oversold on a risk basis. Something like the U.S. equity indexes are not anywhere near oversold. In fact, they're far overbought. So that's not a risk-based component that you actually want to go long on a risk-based move. All right, something like the dollar CAD would be much more along those lines. Now, moving outside of the standard bearings of risk, there's another currency pair that can play towards a technical risk aversion move. Now, I was talking about the dollar Swiss just the other day and talking about how this has to have a breakout. Well, we did get a breakout. All right, you see that very consistent descending channel, and you had that rising channel to put the pressure on it. Well, inevitably we did end up with a very significant break, and the break was ultimately to the upside. But I'm a little concerned here. I have not taken a position. Why? Because remember our conversation. The dollar Swiss is in essence a mirror reflection of the euro dollar. Now, this was kind of difficult for people to understand, so what I did was I actually plotted it out. All right, I put it into a chart for you. So normally the euro dollar and dollar Swiss look like this, but when I flip the dollar Swiss upside down so that the dollar's on the same side of the pair, you can see the correlation that comes through. All right, this creates a significant issue that if you expect the dollar Swiss to actually extend its move to the upside, which a lot of people would, considering they had that channel break, you would also have to suspect, given the level of correlation between these two pairs, that the euro dollar would be dropping off. I'm not as ready to commit to that because even though I'm not confident in the Italian stability, and nor am I confident in Greece, Spain, Cyprus, or any number of other issues that still linger in the eurozone, I don't think it's necessarily an immediate threat. So once again, if you want the dollar Swiss to perform, it actually has to come through risk-based trends. So I know this is a really good technical setup, but the fundamentals are a very real and very significant question that we should hold off and really respect. Now, falling outside of the pure risk trends theme, the Euro Kiwi was a trade that I actually took yesterday, and I was trading off the reversal up here that we had. First, this was the 8-hour bar. The first lower low on this this time frame we had in through the second half or the evening hours, the early Asian session Thursday, and I decided to take a short after it spiked higher and failed on New Zealand-based data, which is going to be a temporary influence. Well, it ended up being good for about 90 pips. I think I took the second half off. The first half I booked at 80 pips, which was my the equal to the initial stop. So it was a good short-term trade. I could have potentially gone for more and try to look for the bottom of this larger wedge formation, but it's not worth getting greedy because there is a lot of chop in this particular pair, and it's not one that I'm just going to try to hold as long as I can, trying to squeeze out a couple more pips. Now, the pound Kiwi is not the same. This one is more prone to, even though it's really tight congestion, when it starts to make a move, it keeps going with that move. That's an interesting situation because we have a descending channel. This was a record low, and as you can see here, an inverse head and shoulders pattern with a clear horizontal neckline at 84, 184. That is a very nice overall setup. All right, when you have these consistencies, it's best not to ignore them. Now, what would best play to this? Well, if the pound sees a recovery, it's dangerous for the Bank of England next week, or if the Kiwi has a significant drop-off, which does have its influences on risk trends, though both of these currencies are sensitive to risk trends. So you get further away from the epicenter. It's not as volatile, but it still has its secondary connections. I like the technical pattern. You can play more on the technicals here than you can on something like the dollar Swiss, but it still would do best if you have the right fundamental mixture to it. All right. So there's a lot of opportunity out here. There are some great looking technical patterns across the board. All right. Very, very attractive. But you have to be exceptionally careful because technical patterns alone do not make for a good trade. You have to have not just the break or not just the reversal, you have to have the follow through. All right, and the follow through from a fundamental standpoint of view is going to come from risk trends. All right, keep a close eye on these risk trends. This is going to be the key theme, and into the end of the week, it's unlikely that we get resolution on it unless a panicked swell comes from the market, and that's always a possibility, but it's a low possibility. Nevertheless, keep your eyes on these markets, watch your fundamentals, and watch your technicals. Good luck trading out there, guys, and I'll wrap you up for the end of the week tomorrow.